Let's bring in Kevin Green, senior markets correspondent, right away to help set up the action today. KG, missed you yesterday. Good to see you to start out this month of trading. We ultimately finished higher yesterday, but before we get into some of the equity price action, I want to get your read through on this cut to the growth forecast by the OECD. They cut both the global growth forecast and the U.S. economic forecast. So talk to us about what exactly happened here, and then we'll talk about what this signals.
Yeah, you are seeing a little bit of a revision to the downside when it comes to GDP growth, not only here in the United States, but they're also projecting that on the global scale as well. They're cutting their global GDP forecast to 2.9%. That's down from 3.1%. And as you talked about at the start of the show here, the U.S. GDP for 2025, they slashed that down to 1.6%. That's down from 2.2%. Now, obviously, they're leveraging the tariff and trade war battles that we are seeing that could cause a little bit of economic slowing across the globe here. And they're also kind of highlighting the fact that maybe some of the macroeconomic data is showing some weakness, particularly here in the United States, and also looking at Mexico as well, and as well as Canada, which are going to be obviously three big powerhouses when you're looking at this conglomerate of countries here. But overall, this is something that's really kind of matching the trends when you're looking at industry expectations. Even if you're looking at some of the other macro analysts out there, they are kind of pulling back their expectations when it comes to GDP because of the uncertainty of the unknown moving forward here. So Diane, is this going to be a huge headline mover as far as the markets? We saw this about a month ago, 2 months ago, and it really was digested pretty much intraday, and we continue to move forward for other news items. But it is something to kind of keep on the radar here that the slowing is being priced in. Now, if we see some form of a reversal when it comes to tariff policy and we start seeing some deals being made here, maybe those forecasts will be revised to the upside here. But a lot of the commentary, especially when you're looking at this note, is kind of stating that there already is some damage being reflected, and that's why they did see this revision. So I think it's kind of on par. I think the market's already kind of priced in that maybe some tariffs will be a slowing mechanism here for the global economy. I think for us in the United States, we're just waiting on the hard data to really kind of reflect that, or if it's going to reflect it at all.
Okay, so it's kind of a wait and see game in terms of what market perception is.
Yeah, because we haven't had the hard data yet. Yeah, we haven't had the hard data to really kind of support that slowing narrative here. If you kind of look at certain pockets, especially in the PMI data, you are seeing some weakness, especially in the manufacturing portion. We had the ISM manufacturing data that came out yesterday. What was actually very interesting there, you did see a slowing when it came to prices, but you completely saw a drop off when it came to imports as well as exports. And we also saw that with the personal spending and income data as well. A part of that component is also looking at imports, and we saw the largest drop in imports, I believe, since 2008, if I'm not mistaken, a contraction of around 11% on a month-over-month basis. So there's a lot of variability that comes with the data. We do have the jobs report on Friday. Everybody's going to be looking into that to see if there's any type of cracks or weakness being reflected here. But the hard data really hasn't shown a complete drop-off in economic activity, even though the writing is definitely on the wall, especially when you're looking at the import-export data. And that's another reason why you're seeing the Atlanta Fed GDP now forecast is looking for around 4% GDP growth, 3.8%, if I'm not mistaken, GDP growth for Q2. And that's not because we're consuming more. It's because of this complete imbalance that we have with imports and exports. So a lot of murky data right now, and we're just going to have to wait until we start seeing a defined trend for a couple of months. I think the Fed's probably going to be waiting for that as well.
Okay, so I want to talk a little bit about what we've seen in terms of moves in the dollar. You're seeing it recover some ground today, back above 99 for dollar against a basket of currencies. When you think about this pressure that's been on the dollar recently, and then the bank's calls, we're looking at Morgan Stanley, Goldman, JP Morgan Chase, all predicting more weakness to come. What does that signal?
Well, some weakness in the dollar is going to be mechanical in nature as you generally get up to a Fed cut or a Fed cutting cycle, which I think the market's been kind of waiting on and trying to price that in. Usually you will see the dollar kind of drop off because it is a sign that we may have some economic weakness here in the United States. And anytime that you're looking at currencies, you're looking at them at a pair standpoint, which country is doing better than the other is usually kind of how you look at that. And so, yes, you are seeing some weakness when it comes to the dollar, especially yesterday hit a really critical area of support. And as you kind of talked about, you have a lot of shops out there like Morgan Stanley, JP Morgan, Goldman Sachs, calling for the dollar to actually move a little bit lower. Morgan Stanley is actually seeing the dollar index falling another 9% down to that around that 91 level by mid 2026. And they are also looking at, like, if you're looking at JP Morgan, they're also looking at long positions in the yen, euro, and Aussie dollar. So you're seeing a little bit of a rotation. I wouldn't freak out about it too yet. It's about the trajectory or the velocity of the move to the downside, a gradual move to the downside. I think probably the markets are going to be able to sustain that, and that'll be okay. Now, we also have to keep in mind too, as the dollar gets weaker, export demand theoretically also goes up. So this could actually be a positive for the manufacturing sector as well as the industrial sector as a whole. So once again, we might see some lower prices when it comes to the dollar index just in general, but it's just the velocity of that move. It's a gradual move. I think we'll be okay. And actually, if you look at historical data, the U.S. Equity markets actually respond pretty positively to a weaker dollar, and depending on the context. And right now, a gradual move to the downside probably would be a tailwind for equities.
That's fair, because obviously some sectors are going to be more exposed to dollar weakness. But let's talk a little bit about the equity action that we saw yesterday. We actually started out weaker, but ultimately finished the first trading day of June higher. Would you attribute that to technical buying, or is the market kind of looking past the slower growth narrative?
I think it's going to be a little bit of both. You have seen a broadening out of this rally, and right now it's going to be looking a little bit more defensive. Now, we could have a head fake for this morning, so just be mindful. Utilities probably will be outperforming because of the CEG deal that's going to be done with Meta. I know we'll talk about that in a little bit. So you are seeing utilities outperform, which is usually a defensive sector. But I think the market is trying to maybe look past some of this, trade war issues that we've had. There's been some acronyms thrown out in this market here where some individuals are buying the dips on bad data, and it seems like that has been paying off. Another reason why you are seeing maybe the market's looking past this is not so much the equity market, though, Diane. It's actually the commodity market. Silver had one of the best days that it's ever had yesterday, moving to the upside. Silver is generally a risk on economic growth, inflationary asset product. And so you saw that moving higher. Oil is also moving to the upside right now, actually making a pretty decent and aggressive move. If you have a complementary move with equities along with commodities moving higher, I think that's also giving you that signal that maybe the market's discounting maybe some of the near-term fears for now until we get that economic data. And then we will be seeing, it sounds like from the reports coming out of Bloomberg here, that the U.S. might be asking for these final trade deals coming from these countries by the end of tomorrow. So trying to accelerate some of these trade deals as well could be a catalyst for an upside move.
Yeah, I have seen that there's some pressure to come to the table by Wednesday. And really quickly, KG, is your target to the upside on the S&P 500 still 59.50, or if not, what is it, and what is it to the downside?
Yeah, for today, 59.75 to the upside. To the downside, first level 5900, key area of support. Second level, if we break that, 58.75, Diane.
All right. Thank you, KG. That's our Kevin Green, senior markets correspondent. Appreciate it.